Hello learners, hi, how are you all? This is the examination month. You have your examination around the corner coming up in another week or so. And I am here to fulfill the promise that I made all of you people, saying that I'll be doing CA Foundation marathon revision of the paper Principles and Practice of Accounting. Yes, let me tell you the overview of how this marathon revision is going to be. It's going to be a 5-part marathon revision consisting of 5 videos of your 10 chapters of CA Foundation syllabus. Each video will cover 2 chapters of your syllabus, all the units within them. So video number 1 will be, or part 1 will be comprising chapter 1 and 2. Part 2 will be comprising chapter 3 and 4 and so on. However, the third part will be little longer for an obvious fact that it will cover chapter 6, which has several units within the same. So I cannot promise you that the entire 5-part video will be within 5 hours. It's going to be somewhere between 5 to 6 hours of videos that you should watch to revise entire CA Foundation principles and practice of accounting. So without wasting much time, come let's get started with part 1 of our CA Foundation Marathon Revision. And as I mentioned to you people previously, in this part 1 video, we will be covering the topics of chapter 1, that is theoretical framework, and chapter 2, accounting process. So let's get started. Before that, a small announcement to all of you people. This is regarding the mega revision free test series conducted by Unacademy platform. June 15th is the date on which principles and practice of accounting, your cute name, pet name that you've given, accounts, will be tested. There's going to be 30 minutes of time to solve 20 MCQs. Similar date, similar pattern has been set up for your law, maths and economics paper on 18th, 21st and 23rd of June. I hope you'll all enroll and then take the benefit of the same. And there is CA Intermediate Mega Combat coming up on June 12th, a gamified version of a quiz. And taking up this will let you take huge discounts on your Unacademy CA Intermediate subscriptions, what you definitely need right after your foundation examinations. And you can always consider taking up Unacademy Iconic subscription, which is the flagship model of Unacademy, which gives you a lot of benefits like one-to-one doubt solving, one-to-one personal coaching, hard copy of material coming to your doorstep, evaluated test series to evaluate your examination preparations, sessions from industrial experts, and you also get to be part of NOD discussion channel. And plus benefits though always there, live classes, recorded backup available, study materials, unlimited access to all the educators, and comprehensive coverage of the syllabus. Yeah, and like I was mentioning, the iconic subscription comes at a cost of 41,000 for CA Foundation for 24 months and 28,600 for 12 months and 20,500 for 6 months. And you can always use the code YESHAS LIVE, which is YESHASLIVE, to get 10% off on the price that you just saw on the screen. So what are you waiting for? Download Unacademy application today. Follow me, CA Rajavardhan, on Unacademy, and also take up your subscription to help you in preparation for your CA course. That's it. Chalo, without wasting much time, let's now get into our subject. So we are going to discuss from the word accounts. Yeah. So the word accounts, what exactly is this word accounts? Yeah, we need to go way back in time to understand what exactly do we mean when we say the word accounts. Long ago, early men used to write lines on the wall or to draw a number of cattle on the wall to keep a track of number of cattle he has, and then to keep a track of number of wheels that he made, number of children that he has, and everything. So ever since that day, we have been maintaining accounts, and that, my friends, is the origin of account. You get this? So from that day till today, it's still been flooded with accounts. So the moment you wake up in the morning, what we take into our hand, like the phone that we take into our hand, this phone also has a lot of accounts in it, starting with Instagram account, Facebook account, LinkedIn account, Gmail account. All these are accounts. Or the one that tells you your awqat, how much money do you have in the bank, that all by itself is also account. Or investment account, demat account, share trading account, all of this. So we've been flooded with accounts. If you still ask me what is accounts, all I can tell you is accounts is a count of transaction. It is splitting the word accounts into two parts. A count is a systematic track or record. The definition is given by AICPA, American Institute of Certified Public Accountants, in the year 1961. It goes like, accounts is the art of recording, classifying, summarizing in a significant manner and in terms of money, transactions and events which are in part or at least of financial character, and analyzing, interpreting and communicating the results thereof. This, my friends, is the definition. Because you're already in the marathon, I would definitely be doing things a little faster, but this is one part of a definition which can be asked in the examination. But however, in the history of CA Foundation so far, there has been no question on what is accounts. So it is already presumed that you all know it and you would write it. So ICI doesn't question this as such in the exam. Fantastic. That, my friends, is the definition of accounts, what you guys should be knowing. I'll give you a small pause for 2 seconds so that you can take a screenshot, note this down, and then read it. I hope you all have done the same. Let's go forward. And the next question is, who's the father of accounts? So father of accounts is, I hope you all remember the same. Yes, it is Luca di Pacioli, a Franciscan friar who was a mathematician from Italy who wrote the book Summa di Arithmetica Geometrica Proportioni et Proportionalita. However, the earliest mention of accounts is being made by Chanakya, or also called as Kautilya, in the suggestion book that he wrote to the king Chandragupta Maurya. Yeah, the name of the book was Arthashastra, in which he actually told how the state account should be maintained and how the king should administer. It also spoke a lot about economics and quite a lot of other things. However, in the examination, if the question is asked, we would always be quoting the name Luca di Pacioli. However, no such examination question can be expected in the present scenario. All these are the root basics. I'll just run you through them in the first 10 minutes. Fantastic. How do we approach accounts? Entire accounts can be approached in three normal ways. Number one is the English approach, or the UK approach, or the traditional approach. The second approach is what we call as US approach, American approach, or modern approach. Third approach is what I cooked up and I made up. That's what I call as the Bangalore approach. Yeah. So internationally speaking, there are only two approaches: the UK approach, US approach, English approach, American approach, or traditional and modern approach. Bangalore approach is what I made to simplify the entire process of accounting that we're going to do over the next 9 chapters, and to spread my love to this place where I come from, Bangalore. Yeah. So what exactly is Bangalore approach? If I make a fist and then punch it to you in the screen here, that's what we call as bang. And once I punch it, my knuckles would start hurting. I would open up my fingers and then start flashing them. Yeah. When I do that, the rest of the 5 fingers will take the remaining 5 letters that is there in the spelling of bang. So bang, L-O, A, L, O, R, E. So wherein A stands for assets, L for liabilities, E for owner's equity, R for revenue, and E for expenses. So these 5 things, basically these 5 fingertips, will make entire accounts come into your fingertips. So let's get started to understand how exactly does each of them function. With regard to these 2 fingers, thumb and the little finger, asset and expenses, if they are increasing, you would have to debit. If they are decreasing, you would have to credit. And when it comes to the other 3 fingers, that is liability, owner's equity, and revenue, if they are if they are decreasing, we would debit the same. If they are increasing, we would credit the same. That, my friends, is a thumb rule that we can use throughout over the next 9 chapters to remember what is to be debited and what is to be credited. So asset and expense, increase debit; asset and expense, decrease credit. Liability, owner's equity, revenue, decrease debit and increase credit. You might be wondering, it is a marathon revision the day before exam and someone is teaching you how to debit, how to credit. We will start from ABCD of accounts. We will go on to discuss how to maintain accounts for a company in the last 5th part of the video. So we're going to cover every concept that's there. However, we are not going to solve any questions in this marathon revision. I hope you all got this. Let's get going. So the UK approach, English approach, or traditional approach. How does it work in here? In here, the classification is made based on the golden rules of accounting. Yeah, there are 3 golden rules that's been given. Number 1 is for real account, which says that debit what comes in and credit what goes out. And then we have nominal account, which says we need to debit all the expenses and losses and we need to credit all incomes and gains. And lastly, we have personal account rule, which goes in to say that we should debit the receiver of benefit and credit the giver of benefit. So real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. And personal account, debit the receiver of benefit and credit the giver of benefit. I hope you all got this. Let me now move a little forward into the types of accounts. There are 3 golden rules, but however, types of accounts are only 2. One is personal, other one is impersonal. Personal accounts can be further classified into 3 categories, but first let's see impersonal accounts. Impersonal accounts are classified into 2 categories, that is real account and nominal account. So henceforth, if someone asks you how many types of accounts do you have, please don't say 3, real, personal, nominal. There are only 2 types of accounts, personal, impersonal. Real and nominal are Types of impersonal account. Got it? So, and then personal account can be classified into three categories: real personal account, representative personal account, and artificial personal. Yeah, I hope you all will remember this. And if I have to answer, real account represent assets, nominal account represent expenses and incomes. Personal account is basically related to person. If it is real personal account, it is of people who have blood, skin, bone, skeleton, and everything. Basically humans. Yeah, real human beings like me and you. If it is artificial personal account, it is in relation to the persons who are created by law. For instance, bank, cooperative society, a company, an LLP, a trust, an association of person, body of individuals, all of these are artificial persons. And representative personal account is an account which represents a person, whether real or artificial. It represents a person who's whether real or artificial. For example, prepaid rent, outstanding expenses, prepaid expenses. All of this is not an expense, it is representing a person. Now, when I say prepaid rent, I've paid rent in advance to my owner or landlord. So that account is representing my owner indirectly. I won't write my owner name, neither is it my expense. I'm representing the owner indirectly. Such is our representative personal account. I hope you're all getting very clear with the basics also, or getting to brush them up at a really quick manner. Then we'll go to US American or modern approach. This is very much similar to our Bangalore approach, correct? No? So assets increase debit, decrease credit, and expenses increase debit, decrease credit. Capital, liability, and income increase credit, and decrease has to be debited. That, my friends, is the entire accounting approach that we need to follow. Yeah, I hope you all understood. Now let's quickly see the definition of A for asset. What does asset mean? Asset is a resource. What is asset? Asset is a resource which is controlled by the entity, which is arising from a past event and which will give enduring economic benefit in the future. That, my friends, is the definition of an asset. If you ask me, is the question has been asked on this? No. So far, there is no question on what is asset, what is liability in the CA Foundation exam. Then we have the meaning of liability. What is liability? Liability is present obligation of an entity which is arising from a past event which is expected to result in outflow of resources. And then we have the meaning of owner's equity. Owner's equity refers to the capital initially contributed by the owner plus the profits that is earned during the year minus the drawings that is made during the year. That, my friends, is capital or owner's equity, what we call by. And then we have the word R, which is revenue. Revenue nothing but the amount received or receivable because you have sold goods or services. What is it? Value of all the goods sold or services rendered by the entity. And expenses, my friend, is opposite of revenue. What is it? It is the value of all goods purchased or services taken by the entity. You get this? So this is the meaning of expense. So far in the approach, that is under US approach, UK approach, as well as our Bangalore approach, we've used the word asset, liability, expense, income, and owner's equity. We've defined all of these. Yeah, I hope you guys understood this, and this is the approach towards account. Next, we'll go ahead to see why accounts. This is the characteristic features or objectives of accounts. What is the objectives of accounts? Accounts help us have a systematic record of transactions, and it will help us ascertain the financial performance of the organization, that is profitability. It will also help us understand the financial position of the business, that is what do you say, the balance sheet that we say, or net worth of the organization. It will help us take decisions whether to continue the business, increase the scale of operations, or to decrease the scale of operations. And lastly, it will let us know the solvency position of the business. The next thing that we need to know is what are the functions of accounts. Functions of accounting is it will help us measure the results, it will help us forecast the future, it will help us take the decision, it will help us compare and evaluate with our competitors or within the organization with previous year figures. It will help us have control, and obviously maintaining books of accounts is a part of the statutory regulations that we have to comply. Income tax department wants us to maintain books of accounts. If it is a company, companies act wants us to maintain books of accounts. So there are a lot of legal restrictions which will basically require us to maintain proper books of accounting. Such an activity, such a function of government regulation or taxation is also fulfilled by accounting. And the next thing is what are the limitations of accounting. Accounting is related only with the quantitative aspects and numbers. The qualitative aspects like the health of the manager, feedback of the customer, change in the government regulations, all of this will not be accounted for in the books of accounts, because accounts only focus on quantitative aspects and not on qualitative aspects. So qualitative factors are ignored. Historical information is what's recorded, not what is future. Yeah, the transaction which has already happened is recorded in accounts, and price level changes or inflation is not accounted for. Meaning, a product is being bought. Assume that I bought this for 1,000 rupees, but today the price is 4,000. I will not be accounting for such increase in the price of the product which I already bought. I would be recording it at the historical cost, and I will not be making any change for price level change. Accounts is little biased because account C is based on accounting estimates and accounting policies. So whenever the accountant maintains accounts, he can choose such accounting policies or such accounting estimates which can be little biased. It's not same for every entity, and this can lead to window dressing, fabricating of profits. It might lead to show higher profits than usual or lower profits than usual. Fantastic. That, my friends, is the limitations of accounting. Then we have the last question coming up, which is definitely an examination question, on which this question has come in the exam several times. In the entire discussion that we had so far, this is the most crucial part which you guys have to take a note of. Yeah, what can you do after you qualify as a chartered accountant? This is one way of asking the question. However, in the examination, the question was not asked this way. The question was asked with the language like, what services can a chartered accountant offer to the society? Yeah, so that is the question. So we can also use the language of role of an accountant in the society. So if the question is of role of an accountant in the society, then the answer can be, you need to include as many of these points you can. Services, you can give services of maintaining books, audit both statutory and internal. You can help to people in planning their taxes, financial planning and advisory, management advisory and consultancy, company related stuff like incorporation, dissolution, arbitration, secretarial work. All of these are the services what a chartered accountant can give. And next thing, he can work in industry. Work in industry means work in companies in the field of accounting, in the finance team, in the costing team, in the budget control team, and in the treasury team. These are the departments in which a chartered accountant can play a role and then offer this. So other than the service and industry, what else can a chartered accountant do? He can work in public sector enterprises. When he works in a public sector enterprise, he can provide the services of finance, budget, accounting, auditing, and reporting. Or he can choose to be part of financial fiscal policy framing department, which will help definitely in the promotion of trade, commerce, industry, and public goods and services. Or finally, he can be playing a very important part in the economic growth of the nation. So this is the role of an accountant in the society. Obviously, you cannot write all the points if it is a question for 4 or 5 marker. I don't want you to mug this up, but write as many as you can so that you can steal as many marks as we can whenever you take up this examination of CA Foundation. Get this, guys? So this is with regard to the introductory part. Now let's slowly move on to the next part. Are you ready? In the next part, we are going to discuss the concepts and conventions which are very crucial. Lot of true or false questions in the exam do come from this part. So let's get started and discuss accounting concepts first and then go on to discuss accounting. Yeah, hello guys. Let's get started. Let's now discuss accounting concept. What exactly is a concept? Concept is an idea or a notion which is universally accepted, and it has a universal application also, and it is the basis on which the entire accounting system is kept across. Meaning, financial statements are prepared based on the assumption of all of these. How many concepts do we have? We have 10 concepts, and we're going to discuss one after the other, right? Let's start with first one, that is entity concept, and then we're going to go in the order. Then we'll discuss money measurement, periodicity, accrual, matching, going concern, cost concept, realization concept, dual aspect concept, and lastly objective evidence concept, which is not printed in the ICA material right now, but it used to exist at one point of time. So we'll discuss that as an add-on. So let's start the first concept. We'll start with going concern concept. What does going concern concept say? It says that an organization neither has an intention nor a necessity close down its operation in the near future. There is no restriction on the company to close it in the near future, nor there is any intention of the company to close in the near future. An organization intends to continue for foreseeable future. That, my friends, is what we call as going concern. So it says an organization neither has an intention nor a necessity to close down its operation in the near future. And this is going concern concept. It is the basis for preparation of financial statements of an organization. Then we'll go ahead to see periodicity concept, which says that though the organization has a lifetime which is really long, it has to break down that entire life into smaller parts and prepare books of accounts for the same. Why? To evaluate your results. You can't say no, the life of the business is expected to be so long and I'll not prepare books of accounts right now. When will you prepare books of accounts? At the end of the life. You cannot say that. You cannot say that. So what does periodicity concept say? Periodicity concept says that entire life of the business is divided into small parts called as accounting period, and books of accounts are opened for each of such account. And repeat, entire life of the business is divided into small parts called as accounting period, and books of accounts are opened for each of such accounting period. That, my friends, is periodicity concept. This will enable uniformity, and this is the concept which has brought in the concept of accounting period into existence. If not, people will prepare P&L account for 15 years at once. Because of periodicity concept is why we prepare P&L account at the end of each period to know the profitability of the organization. That is periodicity concept which will bring in uniformity. There are a couple of more points which we will come back to little later. Yeah. Then the next point is we'll start with entity concept now. Entity concept says that an organization is a distinct entity from its owner. Yeah, an organization is distinct from its owner. Owner and organization are not the same. They are two distinct persons. The money contributed by the proprietor to the business, it is capital, what we call it. That capital is an asset from the proprietor's perspective, but the same capital is liability from the business perspective, because they are two distinct persons and they are not the same. If they are the same, they would see the same thing same way. Because they are two different persons, they see the same thing differently. The capital from the perspective of the proprietor is an asset, because one fine day when the business closes, you would get this capital back. From the business perspective, such capital is a liability, because one fine day they would have to repay that capital back to the proprietor. Yeah, so business entity concept says that the business is distinct from its owner and personal affairs are distinct from professional affairs or business affairs. And capital invested is liability to business entity, however it is asset to the owner. That's what I was telling you people about entity concept. Fantastic, we are just now done with entity concept. Let's now go ahead to discuss the next concept, that is money measurement concept. As I told you guys previously, accounting doesn't take into picture the qualitative aspects. It takes into consideration only quantitative aspects. And any item to get into books of accounts, it should be measured in terms of money. If you cannot measure it in terms of money, you cannot write in books of purchase of a goods or sale of assets, rendering of services or expense incurred, anything. It will be written into books of accounts only when it can be measured in terms of money. Got it? So money measurement concept says that anything or any transaction to be recorded in books of accounts should be measured in terms of money. Why exactly money? It is universally accepted unit of measurement. Do you get this? If I ask you what is the cost of a mobile phone, you will say universally accepted currency. You would say in Indian currency some 15,000 rupees or some $100 or some what to say some 8.5 pounds or euros. Anything, any product will be quantified or measured in terms of money. These days, though, faithfulness, friendship, love is also measured in terms. Just kidding, huh? Don't take it seriously. The reason why everything is measured in terms of money is it is a medium of exchange and it is of standard economic value. We are done with those days wherein I was telling, to say, I'll give you one of my cattle, you give me 2 bags of your grains. We are not doing barter transactions anymore. No? That stopped at LKG. I'll give you my eraser, you give your sharpener. No, gone are those days. Done. We're done with money measurement concept also. Let's now move on to the concept of accrual. So far, I hope you guys are liking it. Though it is marathon revision, we are still drilling into the basics and then doing it. and I didn't want to make it one big video of 5-6 hours, because if one of you thinks that you're really good at the basics, you can skip to the second video. You can watch from part 2, which talks with chapter 3 and chapter 4. I give you that option, but if you ask me, I would say there is no harm in watching chapter 1. Yeah, and my friends, if you sit to read, you will not be able to revise concepts and conventions at this pace at which I am revising for you. So the best thing is put it up on TV or put it up on your phone, lay back, sit, and then relax and revise the concept. I am doing the hard work for you people by making the presentation, showing it, throwing out my throat, and then like shouting it for you. You sit back, listen, understand, keep it in your mind, puke it in the exam, get marks, and then you will be through to CA Intermediate. And I will see you in CA Intermediate, wherein I'll take Group 1 accounting and Group 2 advanced accounting. Fantastic. Hello, let's get going. We're now discussing accrual concept. Accrual concept says that though money is everywhere involved in the organization, cash should not be the criteria to decide when to write the transaction. Accrual concept says that we need to record the transactions as and when the transaction happens, and not merely when it is affected in cash. If there is a transaction happening today, purchase of goods, for which the payment is made tomorrow, record the transaction today of purchase. Don't wait for tomorrow, because it affected in cash tomorrow. So transactions should be recorded as and when they happen. Let me repeat. Transactions should be recorded as and when it happens, and not merely when it is affected in cash. That, my friends, is accrual concept. What does it say? Transactions should be recorded as and when they happen, and not merely when it is affected in cash. So there are two accounting approaches. One is accrual, what we just discussed. The other one is called cash system of accounting. The other one is called cash system of accounting. Business houses have no option but to follow accrual system. However, a not-for-profit organization, a non-trading concern, a charitable institution, or a professional, not a businessman, a professional like a doctor, a chartered accountant, who render services, and they do it for clients, what to say, satisfaction. They don't do it to make profit. Okay. So if the entity is a professional organization, they can follow cash system. I'm not saying they should follow cash. They can follow cash system. Yeah. So this is accrual concept. Accounting can be two categories: accrual or mercantile, and cash basis. Accrual or mercantile is the thing to be maintained or to be followed by business houses. However, an entities which are not for profit, non-trading, or related to what to say, profession, they can follow cash basis account. And that, my friends, is accrual concept. Next thing we have matching concept coming up. What does matching concept say? And there was a question, there are a lot of questions coming up on all of these concepts, okay, in your examination, usually in true or false, for which you write the answer true or false. Later the justification is the statement what I showed it to you people. I'm giving you small 3344 liners, which is very easy to read and very important to write in the exam to get those 2 marks in true or false question. And 30 times I've observed they'll ask this short note question as difference between matching concept and accrual concept also, wherein you'll write matching concept ke liye the description that I gave here, same for the accrual concept, and you lace those 2 marks. Got it? Let's now discuss matching concept. Matching concept says that we need to match current year expenses with current year incomes to arrive at current year profit or current year. Imagine a P&L account. In the expense side, we'll write current year expense. In the income side, we'll write current year income. If you compare current year expense with current year income, we'll get current year profit. If we compare little bit of current year expense with little bit of past year expense with current year income, we won't get correct profit. So to get correct profit, we need to match revenues and expenses. That's what matching concept says. What does it say? We need to match current year expenses with current year income to arrive at current year profit. Or this is based on accrual concept, meaning there is a certain expense for the current year. It should be matched with current year income. Sir, I have not paid that expense. Doesn't matter. Even though that is not affected to us in cash, we choose accrual over cash system and record such expense in the current year PL, match such current year expense with current year income, find current year profit. Got it? And this is also based on periodicity. Sir, how is it based on periodicity? We say no, current year, red color see current year. Accrual, blue color. Revenue and expense is recorded as and when it is incurred. That is because of accrual concept. We take items based on current year criteria that is periodicity concept. So in the periodicity concept, if you remember, it will facilitate uniformity. The second point was not written. Second point is matching periodic revenues with periodic income. Got it? Then we have one more point left out in periodicity. I'll come to it little later. Hello? Let's get going. So we're done with 1, 2, 3, 4, 5, 6 is also done. Let's now discuss cost concept. Previously, I told you historical cost concept. You need to record the item at its historical cost. Historical cost refers to the amount that we paid when we purchased the same. See, cost concept says that value of an asset is to be determined based on historical cost. What do you guys mean by historical cost? It is the amount paid when the asset was purchased. Got it? Now, there are several other valuation techniques which we'll learn little later in this chapter only. In this very video, I'll cover it. However, whenever an organization is a going concern, we will follow cost concept. So what if organization is not a going concern? Sixth point, we discussed first now going concern. An organization neither has an intention nor a necessity to close down the business in near future. If such going concern concept is not there any longer, then the organization can follow realization concept. Yeah. So chalo, let's discuss this valuation principles later. But however, in going concern, if it is there, if the entity is a going concern, it has to follow historical cost concept, meaning record all the assets at original price, historical cost. If the organization is not a going concern, then it has to record it at realization concept, that is realizable value. This is opposite of cost concept. Here the value is recorded at the price that you will realize if you sell the product right now. Now I have a laptop as my asset. I bought it for 75,000. I'll record it in my books at 75,000. That is historical cost. I will no longer continue my business. So I will sell all my assets or not just my goods. I will sell my laptop also in such case. If I am selling my laptop, I might realize only 25,000 rupees now because of depreciation. That 25,000 what I'll realize is realizable value. Now in my balance sheet, should I record the laptop at 75 or 25? 75 if the organization is going concern, meaning if I have an intention to continue my business for now, I should record the laptop at only 25,000. If I don't see myself continuing the business for long, in the foreseeable future, I might not continue. In the near future, I'm winding up. Then I'll go ahead and record it at realizable value. See this? Assets are to be recorded realizable value. This is opposite of cost concept. Initially started as a valuation principle to be followed when the organization is no more following a going concern. However, in the modern days, when the revaluation concept is widely accepted, lot of items are recorded realizable value to go ahead with revaluation principle. Yeah, this is something that you guys should know. And in going concern, I told you, the going concern is not there, then you must record it at realizable value and there is no substitute. However, in the modern times, even in several other scenarios, when the organization is still a going concern, they will record at realizable value, giving reason as revaluation of asset to state it at the original, I would say the present value. Got it? So realization concept is done. The next concept that we have is dual aspect concept. Every transaction will have two aspects, that is debit and credit. We need to record both the aspects. You get this? And that's what is the dual aspect concept. So it says every transaction will have two aspects. We need to recognize, meaning see it, measure it in terms of money, and then record both the aspects. So that, my friends, is dual aspect. Accounting equation of asset is equal to liability plus capital as arised because of dual aspect. And now let's move on to the next thing. This and all we'll discuss in the regular batch, and we'll spend a lot of time solving questions on accounting equation and then giving example for all of that. So we can skip that considering the fact that this is a marathon revision. The last concept is objective evidence concept, which says that every transaction which has been recorded cannot be just a book entry. It should be backed with a, what do you say, evidence proving the authenticity of the transaction. Whenever we read a transaction, it should be proved with the evidence that is backing the transaction. That evidence can be either a voucher or bill or any other supporting document. Got it? Every transaction to be supported by an evidence supporting its objective. Bill, invoice, voucher, etc. is the example of accounting concept. So by this we finish accounting concepts. Let's now quickly move into accounting conventions. As I told you previously, accounting concepts are ideas or notion based on which financial statements are prepared. On the other hand, accounting conventions are those things which will arise over a period of time by usage and practice. What is it? It comes by usage and practice. They emerge out of accounting practices. They come by usage and practice. The process of accounting will lead to emergence of your accounting conventions. So first there is accounting concepts. This is the basic assumptions based on which you start accounting, and in the process of accounting emerges accounting convention. Yeah. How many accounting conventions do we have? We have 4 accounting conventions, namely conservatism, consistency, materiality, and full disclosure. Full disclosure is a different color because again this is not given as a convention in our ICI material. However, we'd have to still read this point. Let's get started with conservatism. Conservatism. So what does conservatism say? Conservatism says that we need to record for transactions which is in relation to expense and losses even though they are not happening. That is being prudent and practical. However, if you expect any transactions related to incomes or gains, don't record it unless and until it happens. Yeah, it's like being very prudent. What does conservatism say? It says that record transactions which are related to expense and incomes even when you expect it. However, don't record expected incomes. Let's see this. It says account for all expected expenses and losses, but not for expected incomes and gains. And this, my friends, is called as conservatism. Yeah, this will lead to understatement of income and wealth. This cannot be used as a tool to do window dressing. This has to be taken with neutrality, meaning you should not be inclined to show more losses, lesser profits to save taxes. No, that should not be our intention. You should be of a neutral mind and then pick up a policy which is very conservative, or what to say, which is very prudent. Got it? Done. And the presentation should be faithful. It should not be to deceive the user of financials. Then we have consistency, which says that accounting policies and accounting practices, whatever we pick to follow, should be consistent. Should be consistent from one year to another. We can't keep changing them. I'll follow one accounting policy this year. I'll follow a different accounting policy next year. You cannot keep changing your accounting policies randomly. Accounting policies and principles that you follow should be consistent from one year to another accounting period. There are exceptions wherein you are allowed to change your accounting policies. We'll discuss this when we start our accounting standard. Got it, guys? So yeah, we'll discuss it little bit. That's the part. Consistency is done, and here periodicity, I told you, it will help. It will facilitate uniformity and matching. The third point is consistency. Fantastic. Let's go forward. Then we have materiality. What is materiality? Not everything is important. Not everything will affect the decision making. Certain things will affect. Certain things are very immaterial, can be ignored. It will not affect us in decision making. Yeah. So materiality concepts is that we need to disclose all such items which are material, all such facts and figures which are material, and it will affect decision making. If there are immaterial items which will not affect decision making, they can be ignored, they can be taken lightly, they need not be disclosed like the way material items are disclosed. That's what materiality says. However, there is a small change, full disclosure concept, which doesn't agree with materiality. It says disclose all the facts and figures whether material or not. Then you would say, sir, full disclosure says disclose all facts and figures whether material or not. Materiality says disclose only material facts and figures. Don't you think there is contradiction between them? Don't you think they are fighting among themselves? The answer is yes, they do fight. The solution is pretty simple. Material items will be disclosed on the face of the financial statements. Immaterial items will be disclosed somewhere in the attachment loosely later. You don't have to pay additional stress on it. Got it? That, my friends, is the discussion of accounting conventions, and I hope you did understand the entire concepts and conventions. Quick, super quick marathon revision that we did. Now let's go on to discuss the next part of our chapter 1. The next part of our chapter 1 that we're discussing is in relation to capital revenue. We'll then go on to discuss accounting policies, accounting standards introduction, and then close our chapter 1, then move on to chapter 2. There's one part of chapter 1 relating to accounting cycle, which will cover up in the accounting process, that is chapter 2, which is part of this first video on your marathon revision. Yeah, let's start with capital or revenue. This is a topic on which questions usually come very often in the examination. Lot of questions do come in the exam. What you guys should be prepared for. So they'll give certain items and then ask you to tell whether this is a capital item or a revenue item, or they will make a statement saying that this is a capital item and then ask you if it is rightly capital or. So how do you determine whether an item is capital or revenue? It is based on certain criteria. So the criteria or the conditions that should be considered. This is not in isolation but several items together. That is number one, based on the consideration. That consideration number one is nature of business. A business, if it is relating to real estate, the building purchased will be revenue item. However, if it is an hospital industry or if it is a lodging industry or if it is a service industry or a manufacturing entity and they buy a building, it will be of capital nature. You get this? So nature of the business determines whether an item is capital or revenue. You guys get that? A furniture purchased by a furniture trader is revenue. Furniture purchased by an accountant is a capital. You get what I'm trying to tell? Car bought by a car trader is revenue. Car bought by a businessman who doesn't deal with cars is a capital item. So we need to see the nature of the business. Second thing that we need to see is the purpose for which it is bought. Third consideration is the recurability of the expenditure. How often is that expenditure incurred? Then the next point is we need to see the materiality of the item. How much is the amount of money that's going in for that specific transaction? And lastly, it is the revenue generation. These five are the considerations based on which we decide whether the expenditure incurred or the receipt collected is capital or revenue in nature. Yeah, a lot of questions do come on expenses incurred for construction of huts in the construction of a major building. This hut is constructed for construction of a bigger building. So this is capital in nature. They'll ask repairs to car, that is revenue in nature. Purchase of stationery, revenue in nature. Payment of electricity bill, revenue in nature. Payment of fuel for the vehicle, revenue in nature. Purchase of goods, revenue in nature. What they say, then they say repairs to machine which is bought second hand before use, that is capital in nature, because that's one time expense. You get this? Or they say what we call as overhaul of a furniture. Overhaul is the expenditure incurred for repair at the end of its useful life. Again, such an expenditure is capital in nature. They say whitewash of a building. Whitewash is painting that can be done very often, so that is revenue in nature. However, whitewash expenditure for done for a second-hand building purchase will be capital, because any expenditure incurred before you start using the asset for the first time will be obviously capital. So these are the kind of questions, and there are a couple of items do come called security deposit given for telephone connection, which is neither revenue nor capital because it is just a security deposit. It will be returned to you when you disconnect the telephone connection. So it's a little tricky part, but questions do come, very important aspect, do remember. And there are a couple of times in the CA foundation examination all by itself, the question is just this, meaning how to classify the item into capital or revenue. Tell me the considerations. That's the question they've asked. For which the answer will be nature of business, purpose, recurability, materiality, and revenue generation. So remember these 5 pointers. This is going to save your time, and then someday it might get you 4 marks in the examination. Got it, guys? Fantastic. Let's see the next part. So why do we classify? Because the treatment is different. Revenue items will go to trading or PL. Capital items will go to balance sheet. Capital items will go to balance sheet, whereas revenue items will go to PL. Remember that what are deferred revenue items? These are revenue items which act like capital items, especially because this revenue item like rent, salary, expense is paid for a period longer than a year. It is like 2 years rent paid together. For once you paid 2 years rent. That doesn't become asset. It is 2 years expense paid together. To the extent it doesn't belong to current period, no. It is deferred revenue, meaning it is revenue but not of current year but of next year. So revenue expense of 2 years paid together, in such case, to the extent it relates to current year is revenue. To the extent it relates to next year is deferred revenue. It has to be transferred to the P&L account of the subsequent year. Till then it will stay in the balance sheet of the current year. That, my friends, is deferred revenue. I hope you guys understood, and fantastic. Let's go to the next part. What are accounting policies? When there is more than one way of handling a scenario, when there is an objective, you would have to travel and then reach a destination. There are 2 ways to reach or 3 ways to reach. Either you can take an aircraft, bike, or a car, or a cycle. So whatever you choose to follow is your policy. Similarly, in accounts also there are several instances which can be handled differently. Multiple options are available. And what the organization will choose to follow is its policy. Meaning, accounting policies are principles and method of applying those principles adopted by the organization in preparation of financial statements. Meaning, there are alternative accounting principles and there are alternative methods of applying those principles. So, among the several options available, what we choose to follow and how we follow is our accounting policy. Got it, guys? An example can be valuation of inventory, and it's not method of depreciation. Previously, accounting standard 6 used to regulate depreciation. Then we called depreciation as accounting policy. However, when AS 6 got amended and then got included in the revised AS 10, which talks about property, plant, and equipment now, replacing our old AS 10, which spoke about fixed assets, it clearly eliminated the topic of accounting for depreciation as accounting policy. It mentions that depreciation is an accounting estimate. So depreciation is not an accounting policy. This is something that you need to know very clearly. And other examples are recognition of income, treatment of government grant, and fine lot of things. What are the cons or disadvantages of accounting policy? These accounting policies will create lot of disadvantages, like it will take away the uniformity. There will be no standardization, and because people follow different accounting policies, there is no comparison, and obviously when different people follow different things, there is no reliability also, and it's also difficult to select what to follow. Am I right? So there is no comparability, there is no standardization, there is no uniformity, there is no reliability, and there is one thing that's existing: difficulty in selecting the accounting. To overcome this, we have with us accounting standards issued by ICI. Guidance notes have also been issued, but we'll now discuss accounting standards. Now the question is, what, my friends, is accounting standard? Accounting standards are written documents issued by government, expert accounting body, or other regulatory body, covering the aspects of recognition, measurement, presentation, and disclosure. You need to remember it this way: Singh is King wala Akshay Kumar, followed by Shah Rukh Khan of Mehuna, and then what do I say? This Disco Diwali from the Student of the Year. So it goes like this: accounting standards are written policy documents issued by government, expert accounting body, or other regulatory body, covering the aspects of recognition, measurement, presentation, disclosure. So Akshay Kumar, Shah Rukh Khan, then Ting Ting Ting, Disco Diwali. That's it. That covers our accounting standards. Let's have a look at it. What does it say? Accounting standards are written policy documents issued by government, expert accounting body, other regulatory body, covering the aspects of recognition, measurement, presentation, disclosure. So this is the definition of accounting standards, which can be asked in examination. Several times they do ask, write a short note on accounting standards. And they do ask, remember Akshay Kumar, Shah Rukh Khan with Disco Diwali, and you will write the definition correctly to ace the entire 4 marks in your CA Foundation examination. Let's go forward. So accounting standards objectives is to bring in standardization, to bring in comparability, to bring in uniformity, to increase the reliability of the financial statements, and ultimately to simplify the process of selection of accounting policy. See, comparability, standardization, uniformity, reliability, ease of selection is being enabled. Limitation is accounting standards on any given day cannot override law. Law is one who stands at the top. Got it, guys? And it would reduce the number of options, but it will not rule it down to one. There would still be difficulty in selection in spite of accounting standards. Got it? So the standard setting process, this is something that we will discuss in detail in a regular batch, which we can skip now in marathon revision. These are the list of accounting standards, of which you will be reading few of them in CA foundation level. That is little bit of AS1, little bit of AS2, little bit of 10, 26 and 29 is what we're going to be reading in CA foundation. Let's quickly start with accounting standard 1, disclosure of accounting. It basically covers 3 things for us. Number 1, fundamental accounting assumptions. There are 3 fundamental accounting assumptions: going concern, consistency, and accrual. Done. Next thing, it will tell us what are the exceptions for consistency, meaning what are the situations where we are allowed to change our accounting point. I previously, when I discussed conventions also, I told you consistency can be change. There need not be consistency. There are exceptions. That exceptions I told I'll discuss when you do AS1. Here we are discussing it. So what are the exceptions? Exceptions to consistency is number one, when the law wants us to change. Number two, when the accounting standard itself has changed. And third one is for the sake of better presentation. So it is compliance, requirement of law, change in accounting standard, or for better presentation. And lastly, we have consideration. How do we select accounting policy? Selection of accounting policy will be based on the prudence, substance over form, and materiality. These are the three considerations based on which we can select our accounting. That's the end of accounting standard 1. We generally discuss this AS1 all by itself for about an hour in a regular class. However, this is marathon revision and I have to finish it in a couple of minutes. Yep. AS2 is covered in chapter 4, which deals with inventory. AS10 is covered in chapter 5, which deals with depreciation. And AS26, a little bit reference, just a reference. What intangible asset is given to in, that is goodwill treatment in partnership chapter. That, my friends, is the end of the other standards. That leaves us with the last standard, that is provisions, contingent liabilities and contingent. The definition of provision is a present obligation from past event which would result in outflow of resources embodying economic benefits, which is probable. Further reliable estimate can be made of the same. That is the definition of provision. Contingent liability is a possible obligation that arises from the past event that existence is dependent on occurrence or non-occurrence of one or more future events. And contingent asset, same thing. Instead of writing possible obligation, we read it as possible asset. Not so easy to remember, no? I know it was little too harsh and then little too overhead to you people to grasp that. Let me make it easy to you. Contingency is an event. It is dependent on two things: on happening or non-happening of a future uncertain and uncontrollable act. You get this? So if I bet that it will rain today, and if it rains, I'll pay you 100 rupees. I'm saying that it will not rain. So I'm saying that if it rains today, I'll pay you 100 rupees. That is a contingent event. So it is dependent on happening or non-happening. That is raining or non-raining. And that rain is future, because I told entire day, the day is not yet over. It is not in my control and I'm not sure of this. And if it rains, I will pay you 100. So it's going to be resulting in outflow of resources to me. So if this contingent event results in outflow, it is contingent liability to me. And it's going to result in inflow to you, it is contingent asset to you. Sir, why is it not asset to me and why is it not liability to you? Because it is not sure. It is uncertain, uncontrollable and future. Got it, friends? So it is dependent on happening or non-happening of a future uncertain, uncontrolled activity. So contingency is a possible obligation or a possible asset dependent on occurrence or non-occurrence of one or more future uncertain and uncontrollable activities. And if this contingent liability will create provision, if this contingent liability fulfills two conditions, that is condition number one, there is probable outflow. Now it looks very cloudy and it looks like it's going to rain. So probably I might have to pay you. So it will become my liability type. So I would have to create provision because it's still a contingent liability, not a liability. It is going to result in an outflow which is very probable. And I can reliably estimate how much money should I give you. 100 rupees. That's what the bet was for, right? So whenever there is two conditions fulfilled with regard to a contingent liability, that is probable outflow and reliable estimate, then I'm going to make the provision for us. The presentation part is like this: contingent assets and contingent liabilities will not come in balance sheet assets and liabilities because they're not assets and liabilities. They are contingent asset and contingent liabilities. Contingent liabilities should be disclosed as a footnote to balance sheet. Contingent assets need not be disclosed. However, provision will be written in the P&L account as an expense and it should appear in the balance sheet as a liability. Got it, my friends? And that is with regard to accounting standards. Similarly, we have something coming up globally called as IFRS. To keep up with IFRS, Indian version of this IFRS is called as Ind AS, which is little bit of IFRS with some modifications. Like IFRS, you took 100%, eliminated some 3-4% of it, added Indian version of 3-4% to it, and that is the resulting Ind AS, which is followed in our country, slowly being made applicable at a top level for top companies. Then we have accounting valuation principles that I told you people some time ago. Valuation principles, I told historical concept is one of the valuation principle, but not the only valuation principles. We have three more. One is historical concept, what we already discussed. Second one is current cost. I've already bought a product long ago. The price that I paid long ago is historical cost. The price of the product today, if I have to buy, is current cost. And we have sale value, that is realizable value. If I sell the product today, what I get is realizable value. And what benefit am I going to take out of the product in the future? That is my present value. You get this? So the present value of the future cash flows arising from that item. It is discounted cash flows is what we call as present value. These are the other three valuation principles that are there which can be used in the process of accounting. So historical cost is price paid to acquire long ago. Current cost is the price that should be paid now to acquire it. Realizable value is price that we realize if we sell the asset, and present value is the discounted value of the net cash proceeds that we're going to receive from this asset in the future. Got it, guys? This is valuation principles. And last item in chapter 1 that we're discussing is accounting history. Whenever the valuation principles that we discussed here fails, meaning you can't apply these valuation principles to identify the value of an item, then we're going to go for guessing the price. How do we guess? We guess it based on our past experience and understanding the present situation. Yeah, it is done based on the past experience and understanding the current situation or existing situation. We guess the value of an item or express it in terms of money. That, my friends, is accounting history. When we say depreciation of an asset is 10,000 rupees, that is an accounting estimate. When we say useful life of an asset is 4 years, that is an accounting estimate. How do we say that the useful life is 4 years? That is sheerly an estimate based on our past experience with such asset or assessing the current position of the asset. We look at it and then tell that this asset can be used for a next 4 years time. So that is its useful life. So accounting is this, my friends, is the end of chapter 1. Then now we'll move on to the chapter 2, which is accounting process. Let's now start with the topic of accounting process, which is our chapter 2. So in the chapter of accounting process, we all know that once the transaction is identified, the initial place of recording as a matter of our accounting cycle is journal. After that, we post it to ledger. From there, it will go to trial balance and then to final. So let's now understand what exactly do we mean by journal. Are you all? I'm hearing and everything's fine. Fantastic. So journal. Journal are the day books. It's a record of primary record. It's a primary records where the transactions are originally recorded, and the process of recording is called journalizing, and it's recorded in the chronological order. Format of journal, I need not help you guys at this stage. You all know it already. Create the transaction as cash account, debit to capital account. This is for the capital product. Yeah, and what we write below that is called narration. And once a transaction is written in journal, how to pass journal entries? Guys should be knowing it by now. Identify the transaction at first place, then identify what accounts are involved in it, categorize them, and then into either what you say asset liability, expense income criteria, or real nominal personal criteria. Then identify whether it is to be debited or credited, that is based on the impact that's created on them, and that's how you finally pass your journal entry. I've given few demo cases, few transactions, and based on which we'll pass journal entry. This is what we do in the regular class. I hope we can skip that and now move on to the topic of ledgers. Yeah, ledgers. Ledgers are the secondary book of entry, or it is the principal record. Once the transaction is recorded in journal, from there we post it to ledger. So the transfer of journal entries to ledger is what we call as posting, and entries here are not recorded in chronological order unlike in journal. In the ledgers it is recorded based on analytical order, and in this what do we do? At the end of the period, ledgers are closed by either balancing or transferring. Whether to balance a ledger or to transfer the ledger account balance depends upon the type of ledger. If the account involved is a real account or a personal account, it is balanced, and such balancing figure is transferred to the subsequent period, carried forward. However, if the ledger accounts is representing and it is relating to a nominal account, expense or income, then such ledger will be closed by transferring the balance to trading or real account. I hope you understood. Real or personal accounts are balanced. On the other hand, the nominal accounts are closed by transferring to trading or real account. Got it? Real or personal account balanced. and transfer to trading or PL is non-account. That, my friends, is the concept of ledger. I have shown few entries and then told them how do they get posted to ledger. This is all in the regular class which can be skipped at this stage. So what we did right now is we first did journals, then we did ledgers, then these will get posted to our trial balance. So whenever these get posted to our trial balance, so trial balance is not an account, it's a statement which will comprises of all the ledger balances, and this is prepared on a specific date to help us prepare final account. And why is trial balance prepared? Trial balance is prepared to check the arithmetical accuracy. Secondly, to help us in preparation of final accounts so that it will have all the ledger balances in this, and it will act as a summary, which is the only document to be gone to when you prepare financial statement. You don't have to go back and open each ledger or journal when you prepare final accounts. That, my friends, is the reason why you prepare trial balance. And when is trial balance prepared? People usually say annually. The answer is not annually. Trial balance is prepared every time you want to prepare final account. If you want to prepare final accounts quarterly, trial balance should be prepared quarterly. If you want to prepare final accounts monthly, meaning you want balance sheet on a monthly basis, you need to prepare trial balance also on monthly basis. So it is prepared just before preparation of final accounts. This is the correct answer. Then trial balance can be prepared under three methods: total method, balance method, total and balance method. Under total method, what we do is we'll write the totals, total debit, total credit before taking balancing figure. Under balance method, we take the balancing figure in the teeth ledger and post the balancing figure. Under total and balance method, we write the total as well as the balancing figure. Got it? So those are the three ways of preparing trial balance. We do get questions in the examinations on correcting the trial balance, which is actually wrong. I usually show a demo problem on how to prepare total method, balance method, total and balance method. We can skip that right now because we're in the marathon revision. If I discuss that in detail, then I would be teaching chapter 1 for about 15-20 and chapter 2 for about 10-15. Yeah? So it's part of our marathon revision, so I'm skipping that through. In the next part, what if the trial balance doesn't tally? You can't wait to identify the error, no? Because if you wait to identify the error, your trial balance is not closed. If the trial balance is not closed, your final accounts are not prepared. Then if final accounts are not prepared, what will you give to directors or what will I give to users of financial institutions? So financial statements. So the decision will get delayed. In order to ensure there is no further delay in preparation of final accounts, what we do is we create suspense account, and once you write suspense account for the item, for the element, to the extent which the trial balance doesn't tally, such trial balance will now be called as adjusted trial balance. And using the adjusted trial balance, you prepare final accounts. You will show such suspense balance in the balance sheet, asset side or liability side, depending whether it is debit or credit. Later date may, as and when you find the reason for difference, such reason will be replaced with this suspense. So that's what we do in rectification of errors, which we'll discuss little later in this very video. Yeah, fantastic. So that's the process. We do journal, we do ledger, we do trial balance. But in certain cases, preparing journal will become a very demanding and long-term thing because journals are very tedious. It will take a lot of time out of you. If the organization is quite big, they don't really have enough time to record all the transactions in one book called journal and later classify them into ledgers. So what they do, they say we are special. Our scale of operation is different. We want a unique solution. So they follow special journals, also called as subsidiary books. Subsidiary books are also called as what? Special journals. These are followed when the size of the organization is too big and they can't wait to prepare ledgers to classify. What do? They classify at the primary stage only. In the recording in the special journals, they classify the transaction into sales, purchase, cash, non-cash, bills receivable, bills payable, segregate them, and then only write them. Got it? So these are again primary books of entry. These are alternative to journals. Yeah. Why do you prepare subsidiary books? To ensure simplification. Yeah. The following advantage: it will be easier to record, and you can appoint multiple people to record. You get this? Division of the work is possible, specialization is possible, and time can be saved by going through the entire process of tedious journal. Going to cost you more time. And information will be available at the tip of your finger for sales, for purchase, and everything. And it is easier to check and rectify if there is any. Yeah. When do we prepare? When the size of the organization is big. Small business journal, big business subsidiary. Got it? So how many subsidiary books do we have? The subsidiary books that we have is sales book, purchase book, sales return book, purchase return book, bills receivable book, bills payable book. Then we have cash book, petty cash. Let's start with sales book and journal proper also at the end. This is the residuary. Let's start with sales book. Sales book may we record all the credit transactions relating to sale of goods. If it is goods sold on credit, then it is recorded in sales book. If it is goods sold for cash or if it is assets sold on credit, it will not come. So in order to enter a transaction in sales book, it should fulfill two conditions. Number one, it should be goods sold. Number two, it should be goods sold on credit. Then we'll record it in purchase book. What will be recorded in purchase book? Credit purchase of goods. It should be purchase of goods and it should be on credit. Only then it will come in our purchase book. Got it? The next thing that we have is sales return book. If a transaction has been previously entered in sales book and such goods have been returned by a customer back to us, we'll record it in sales return. So it should be goods sold on credit earlier, now return. So it should be credit sale of goods, now return. Next comes purchase return book. It is credit purchase of goods returned. We had purchased the goods previously on credit and now we are returning the same. Then we'll record it in purchase return. I hope you guys understood. Then let's move on to the next one, that is bills receivable book, bills payable book, cash. Bills receivable book. The person to whom we have sold goods, if they give us a bill of exchange, bills receivable, we'll read in bills receivable. We have sold goods to somebody, we have to pay them money, we owe them money. So we give it in writing that we owe them money. Such document will become bills paid. Done. Then we have cash book where we will record all the cash receipts and all the cash payments, whether capital or revenue, whether sale or purchase, whether asset or goods, it doesn't matter. If it affects cash, it will come. Whether asset or goods, whether capital or revenue, whether it is paid or received, doesn't really matter. Understood? And cash book may further there are types. Simple cash book, which is one column, only cash column. Then there is only cash column, like I mentioned. And then there is two column cash book or double column cash book, which will have two columns. People usually say that these two columns should be cash and discount. Some say no, sir, it should be cash and bank. There is no such condition. It is two column cash book. One column is cash. The second column can be bank or it can be discount. Doesn't really matter. And then comes three column cash book, which will have discount column in it. So debit side will be discount allowed, credit side will be discount received. Because discount received is income, credit, discount allowed is expense. I hope you all got this. That's with regard to our cash book. Then we have petty cash book. This is maintained under impressed system because all the transactions relating to small amounts of money cannot be made in the main cash book. So whenever petty expenses are paid, what you do is you appoint a petty cashier, you give him certain sum of money, ask him to discharge the money from the petty cash. Whenever the petty cash box is empty, main cashier will fill in money. So a petty cashier is the one who keeps track of all these petty small payments. This will save the time, labor, and the labor of the main cashier, and it will appoint a specific person who can control all these petty payments. Because if we go to the main cashier for small payments, he might not check the genuinity. He might not have the time to check. So he might just make the payments without checking. Or if he goes into checking, lot of time and labor of his will get wasted. So the solution is petty cash book. Lastly, we have journal proper. Journal proper is a subsidiary book which is called as a residuary book. A transaction which doesn't go into any of the other books, like a transaction which doesn't go into sales book, purchase return book, sales return book, cash book, petty cash book, will come in journal proper. This is for credit purchase of assets. Because it is assets, it will not go to purchase book. Because it is credit, it will not go to cash book. Where do you write it? In journal proper. Or any adjustment entries, depreciation entries, rectification entries, all this will be written in journal proper. The format of journal proper is same as journals. It is actually a journal book always. Got it? Fantastic. That, my friends, is subsidiary books and the entire accounting process. We have something left with in this chapter of accounting process, that is rectification of errors, which is the last unit, unit 8 of our chapter 2. But I will still discuss it in the second video. Actually speaking, the first video is for chapter 1 and 2 and the second video is for chapter 3 and 4. But we'll discuss rectification of errors also as a part of our chapter as a part of our part 2 video, because that goes in line with our BRS topic, and we had too much of theory to discuss here in first video that we did it all. So those of you who want the practical side could have skipped this first video, and when they start with the second video they can start watching the practical side of accounting. I didn't want to take any of the theory aspects lightly, because theory aspects do come up in the exam for good amount of marks in the first true or false questions and in the short note questions in question number 6, and I don't want you to miss out on. That's it, guys. So this is the end of part 1 of CA Foundation Principles and Practice of Accounting Marathon Revision. I hope you're all liking it. See you all in the second video. Till then, remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun. It's all good. The day you guys either stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question to all of you. Are we in the game? I hope really your answer is yes, we are in the game. Waiting to see you all in part 2 of CA Foundation Marathon Revision, wherein we'll start with rectification of errors, then go on to do the concepts of BRS and valuation of inventory. Bye guys, stay in the game.